we just talked about the 10-year Treasury rate, 177 right now. Are you surprised to see the move we have seen, this very dramatic move over the last couple trading sessions? And where do you think we go from here?
Yeah, actually, so we're down, I think, about 30 basis points in the past week on 10s. It's a really challenging time, I think, for Treasury markets, just because they're dealing with a lot of conflicting signals. You know, coming into the FOMC meeting, I think there was a lot of expectations for, either a more aggressive ease on the part of the Fed, or some sort of signaling that something would follow. So they didn't really get that coming out of there. The follow-up move by the president to initiate new tariffs on China obviously shocked the market. That was sort of a 1-2 punch. And now the retaliation. Obviously, all things considered, this has been a massive sort of increase in market expectation for risk. And I think it's a particularly difficult time for Treasury markets from the standpoint of seasonally, we're just at very low market depth. As we sort of enter August, we tend to lose market depth of about 15 to 20% as we go from midsummer into August through Labor Day. So not as many participants to absorb. And at the same time, we've also had primary dealer inventories running near all-time highs. So they may be less active in intermediating than they normally would.
Alan, Byron Wien just told us he thinks a U.S.-China trade deal happens in 2020. You agree?
Oh, tough one, really. It doesn't look likely at this point in time. It seems like both sides are really digging in for the longer haul in a way in which I wouldn't have anticipated if you asked me the same question maybe a couple of months ago. So I think at this point in time, put it this way, I think we've got to play again with what's in front of us. And it still feels to me like we've got to work through the idea of tariffs being implemented at the beginning of September, and China pursuing some tit-for-tat, really, inclusive of currency weakness.
How much do politics matter then at this point? Because if there were a deal in 2020, that presumably would help the president's re-election prospects. Do you think the Chinese are thinking about that?
They may well be. I think they may view President Trump as something of a double-edged sword. On the one hand, maybe he's actually weakened the U.S.'s presence globally. That'd be one possibility from a Chinese perspective. On another hand, clearly he's raised additional tensions vis-a-vis China, and they want a much smoother relationship going forward. So maybe they see alternatives there in 2021, for example, that might be helpful.
Do you think that the threat of a currency war is a real one? Is it something that's concerning you right now?
I think it is, yeah. I mean, I think the war, the idea of a war is maybe a set of language we could abstract from. But it does feel like you're getting into a situation where China is pushing and using the currency as a weapon. Also probably language one probably doesn't want to use, but it's evoking a response and could evoke a response from the United States.
Alex, what's the bond market telling us right now? What is it signaling, and I guess what do you see as the biggest risks?
So I think the bond market is reacting to the news. It's anticipating that that they're probably going to get an easier stance from the Fed than what they've seen so far. I think the bigger risk, as we sort of look out over the span of the next few months, is the market may not get exactly what it's looking for. Right now, we're anticipating one more 25 basis point cut in September, and to the degree we either get a larger response at the September meeting or further eases after that. The Fed has told us they're going to be very data dependent on that, and that I think is the risk there is. Domestically, the data have been, reasonably good. In fact, we had two of the regional bank presidents, object to the easing move last week. We'll see whether or not that sort of persists. But there's this tension, I think, between what we're actually seeing domestically and what we're seeing in the global data. The global data, we're seeing, the responses, the anticipation of more easing in the Eurozone, in Japan. So there's definitely a dichotomy between the U.S. economy and what's going on sort of elsewhere in the DM markets, and that's something that I think keeps pressure on the dollar and keeps pressure on the rates markets.
Yeah, well, to that point, I mean, the entire yield curve in Germany is negative. So how in the world can how can rates go appreciably higher here if that continues to be the case with some of our largest trading partners, whether it be Germany or even Japan?
So I think the question there is, how is the U.S. market, how is the U.S. economy different than the German economy? We have continued to see growth in the 2% area. We continue to have pretty decent performance in the employment data that we saw last week. So as long as we sort of have the economy sort of progressing at these sorts of levels, that's outpacing sort of what we're seeing elsewhere. I think it does keep attention, I think, between sort of where the dollar is and where rates are, and I think that's something we've seen, for some time, and I think it's a theme that persists into the future.
Alan, given the fact that we are seeing such notable moves, not only in markets here but globally as well, do you see buying opportunities right now?
I think it's still too early. I think when you've seen in the past these tariff issues rear their head. We've had 3 different episodes in the past. Typically, U.S. equities have fallen by between 5 and 10%. This one looks a little bit more serious than the others. I think we've kind of gone another step further, a little bit like we spoke about earlier. There's this tit-for-tat element that's now playing out. So I would say we're looking at potentially more substantial declines. So let's see this play out. It's a little too early, I think, for buying opportunity.